The markets feel loud right now. Not loud in the way of breaking news alerts or flashing headlines. Loud in the quiet way, the kind of noise you only hear when money starts moving before people do. Across the world, almost every major asset has been wobbling at the same time. US stocks, Japanese government bonds, even assets people usually run toward when they feel scared. Gold hesitated. Crypto lost momentum. That alone should make you pause, because money normally rotates. It doesn't vanish. When stocks struggle, money hides in bonds. When bonds struggle, money hides in gold. When gold looks tired, money hunts for something else. But when everything weakens together, something different is happening. This isn't rotation. This is evaporation. And once you understand why, you'll stop looking at individual stock charts and start watching the system itself. The transcript you shared describes this moment well, but we need to zoom out and connect the dots across history, incentives, and human behavior. The framework from the passive path is clear on one thing: prices move last. Cash flow moves first. Not your paycheck, not your savings account, the smart money flow that quietly shapes markets long before headlines catch up. Money never asks permission, it reacts to pressure. When pressure builds inside a system, money looks for exits. And when it can't find safe places to park, it leaves the system entirely. That's where we are now. People keep asking a simple question: is AI a bubble? But that question is already outdated. The better question is this: where exactly is the bubble hiding? Because bubbles are rarely where the crowd thinks they are. In 2008, the bubble wasn't houses, it was borrowers who could never repay. In 2000, the bubble wasn't the internet, it was business models that never made money. Today, AI feels like the obvious suspect. The valuations are enormous. The hype is everywhere. The promises are endless. And yet, the companies selling the picks and shovels are reporting record profits. Nvidia's revenue keeps growing. Quarter after quarter, margins stay high. Demand looks endless. So how can something that profitable be part of a bubble? This is where most people get trapped. They confuse revenue with sustainability. During the gold rush, the people who sold shovels got rich. That didn't mean gold was easy to find. It just meant hope was easy to sell. Right now, Nvidia is the shovel seller, and OpenAI, along with dozens of AI startups, are the gold miners. Here's the uncomfortable part: the miners aren't making money. OpenAI is burning billions each year, not slowly, rapidly, and yet they keep buying more chips, signing bigger contracts, building larger data centers. That should raise a question: where is the money coming from? This is where the story becomes dangerous, because when customers can't pay, sellers start financing the sale. It happened before. In the late 1990s, Lucent Technologies dominated internet infrastructure. If you wanted to build the internet, you bought from Lucent. Demand looked unstoppable. Revenue exploded. But behind the scenes, Lucent was lending money to its customers so they could buy Lucent equipment. Sales rose, cash didn't. Accounts receivable grew faster than actual payments. Inventory piled up while executives said demand was on fire. Then the customers stopped paying. The revenue vanished. The stock collapsed. Lucent disappeared from relevance. History doesn't repeat perfectly, but incentives rhyme. Today, Nvidia reports enormous sales, but a growing share of those sales hasn't been paid yet. Receivables are rising. Collection periods are stretching. That doesn't mean fraud. It means strain. Because when your biggest buyers are losing money, something has to give. And the biggest buyer in this entire ecosystem is OpenAI. OpenAI doesn't sell shovels. They sell dreams. And dreams don't generate cash flow fast enough to pay for the infrastructure being built. So the system compensates. Money circulates. Nvidia invests in OpenAI. OpenAI uses that money to buy Nvidia chips. Oracle signs long-term cloud contracts with OpenAI. Oracle uses those contracts as collateral to finance more hardware purchases. The money leaves Nvidia, then returns to Nvidia. On paper, everything looks strong. In reality, the system is feeding itself. This works only as long as confidence stays high. The moment confidence cracks, the loop breaks. That's why stock prices fall before profits collapse. Markets are forward-looking machines. They don't care about today's revenue. They care about tomorrow's payments. And this isn't just about tech stocks. If this were only an AI bubble, US equities would fall while safe assets rose. But that's not what's happening. Japanese stocks fell, Japanese bonds fell, the yen weakened. That tells you something important. Global liquidity is tightening, not rotating, tightening, which brings us to the real problem, the US dollar, not collapsing, but being repositioned. For decades, the dollar's power came from trust, trust backed by gold reserves, military strength, and financial dominance. Today, something new is forming, stable coins. At first, they seemed harmless. A technical convenience, a faster way to move dollars, but stable coins are quietly becoming something else. A second layer of money. Here's why that matters. If you hold US treasuries, you can issue stable coins. Those stable coins circulate like money, but the interest on the treasuries flows to the issuer. That creates a powerful incentive. Banks want treasuries, funds want treasuries, institutions want treasuries, because treasuries now produce yield plus money creation, and who benefits? The system. This is how demand for US debt gets rebuilt without forcing people to buy bonds directly. Gold once played this role, now Bitcoin is being absorbed into the system. The US government holds massive Bitcoin reserves, BlackRock holds more, ETFs bring global demand through US markets. Stable coins link digital assets back to dollar infrastructure. Everything flows inward. This isn't collapse, it's consolidation, and consolidation is never painless. When money is pulled back toward the center, asset prices elsewhere fall, stocks, crypto, commodities, not because they're worthless, but because liquidity is being reclaimed. That's why everything feels heavy at once. This isn't a single bubble popping, it's a system rebalancing under stress. And here's the part most people miss. You don't have to invest to be affected. Your pension fund invests, your insurance company invests, your employer depends on credit. When liquidity dries up, layoffs follow, not because people did something wrong, but because the system tightened. That's why understanding money flow matters more than picking stocks. The question isn't whether Nvidia survives. It probably will. The question is how many players below it won't. Because bubbles don't burst at the top. They burst at the weakest link. And right now, that link is cash flow. Not revenue, not valuation, cash flow. In the next part, we'll talk about what protection actually looks like in moments like this. Not panic, not prediction, positioning. We'll talk about why holding cash isn't cowardice, why patience becomes a weapon, and how history rewards those who step off the tracks before the train arrives. Because survival always comes before growth, and the people who understand that don't just protect their money, they protect their freedom. Cash feels boring. It doesn't promise growth. It doesn't tell exciting stories. It doesn't trend on social media, but cash has one underrated feature. It survives. In moments like this, survival matters more than speed. When liquidity tightens, leverage becomes poison. Debt stops being a tool and turns into a trap. Assets that looked unstoppable start competing for the same shrinking pool of money. This is when people confuse volatility with opportunity. They see prices fall and think value has appeared. Sometimes that's true. Most of the time, it isn't. A falling price doesn't mean something is cheap. It means someone needed cash more than they wanted the asset. That distinction changes everything. Right now, the system is doing three things at once. It is pulling liquidity back toward the center. It is testing which business models can survive without constant funding. And it is forcing governments and institutions to reveal their priorities. The AI story is only one chapter inside this. What matters is what happens when the funding slows. Commons that truly create value will adjust. They will slow expansion. They will focus on profitability. They will shrink before they break. Companies built on belief alone will not have that option. They need constant inflows. They need optimism. They need rising prices to survive. Once prices fall, the math collapses. That's why watching stock prices alone is misleading. The real signal lives underneath. Accounts receivable growing faster than cash. Inventory rising while demand is described as strong. Customers paying later, not sooner. Financing disguised as sales. These are not red flags on their own. They become red flags when they cluster. History is ruthless about this. The internet didn't fail. Most internet companies did. Housing didn't fail. Borrowers did. AI will not disappear. Many AI companies will. The system always keeps the tool and discards the excess. For individuals, this creates a quiet advantage. You don't need to predict which company survives. You don't need to time the bottom. You don't need to argue with headlines. You only need flexibility. Flexibility comes from liquidity. Liquidity comes from restraint. Holding cash during expansion feels foolish. Holding cash during contraction feels powerful. Cash gives you optionality. It lets you wait while others rush. It lets you buy when sellers are forced, not hopeful. It lets you move without asking permission from market. This doesn't mean hiding forever. It means respecting cycles. Cycles punish impatience and reward endurance. People often ask why markets feel harsher now than before. The answer is simple. Debt has grown faster than income, expectations have grown faster than reality, and time between crises has shortened. There is less room for error. That's why the smartest move is often the least dramatic one. Reduce exposure to forced selling. Avoid leverage you don't control. Focus on resilience over returns. When the system is stressed, survival compounds faster than growth. Eventually, the noise will fade. Liquidity will return. New leaders will emerge. They always do. But they emerge after excess has been cleared, not before. Until then, clarity matters more than confidence. Understanding where money flows is more important than believing stories. And patience is not passive. It is strategic. The goal was never to scare you. The goal was to help you see clearly. Markets move in cycles. Money moves before headlines. And the people who survive every cycle are not the loudest or the fastest. They are the ones who protect their position before chasing the next one. If this video helped you see the system from a wider angle, take one simple action. Press like so the algorithm knows this topic matters. Subscribe to the channel so you don't miss the next piece of the puzzle. Leave a comment with your perspective or your questions. And share this video with someone you care about who might need a clearer view right now. If you want to go deeper, feel free to watch other videos on the channel. Each one connects to the same long-term picture. Good luck, stay patient. Protect your capital first. I'll see you in the next video.